Hey guys, just back again with another one. This is our final exam, folks. Chapter 17 on financial statement analysis. I'm actually going to show you the answers to everything without actually working them out. And here's the only reason why, because when the calculating numbers is not hard, okay? Anybody can calculate numbers. That's not a big deal. But interpreting what the numbers mean, that's where the action is, okay? So I'm going to kind of race through the calculation parts here. We have over here summary for Barco and Cayenne Company. This is the balance sheet right here. We have assets over here, we have liabilities and equity over here, we have over here the income statement, and we have some beginning balance data that would have to do with the balance sheet. Okay, these are beginning balance, meaning last year's ending balance. Okay, this is from last year's balance sheet that we need to answer questions for some of the stuff here on our balance sheet over on this side. So this is a good to know. Alrighty, income statement, balance sheet, beginning balance of balance sheet, that is the ending balance from last year's balance sheet numbers, because we're going to have to take some averages, and I'm going to be drawing from these numbers as well. And we got them broken up between Barco and Cayenne, Barco and Cayenne. Okay? Requirement for both companies: compute, and they list a whole bunch of ratios. I'm not going to run through them. It says here round to one decimal place. Number 2, compute some more ratios, round to one decimal place. And then it says identify which company's stock you would recommend as a better investment and explain why. Okay. Alright. Current ratio. Current ratio is the easiest one. It's the one I remembered most of all the ratios. It's current assets divided by current liabilities. So I look over here, and where are my current assets? Well, cash, accounts receivable, current notes receivable, merchandise inventory, prepaid expenses, pretty much everything up to but not including plant assets. Once you hit plant assets, we're talking long term. So go only for the current things that are going to become cash within a year. That's the classic definition. And that's going to be all these numbers: 19.5, 37.4, 9,001, 84,440, 5,000. And look over here: 19.5, 37.4, 9,100, 84,440, 5,000. All of these are current assets, and they show up on the numerator, okay? And then my denominator is going to be current liabilities. So current liabilities says here current liabilities for 61,340, and then right after that long term. Got to put the brakes on because this is no longer current. This is long term. So they actually were merciful. They gave you only one number, 61,340. That's it. So you calculate these. It comes out to be 2.5 is the answer, and they say 2.5 to 1, meaning on a 1-to-1 ratio, dollar for dollar assets to liabilities, you had 2.5 times more assets than you have in liabilities. That's what this means. 2.5, 2.5 times more assets than you have liabilities currently. So if you really had to pay off your current liabilities with current assets, could you? Sure you could, 2.5 times over. Yep, you sure could. Alright, let's take a look at the asset test ratio. And I'm just going to do this with Barco. Asset test ratio means the things that you absolutely positively had to collect cash for quickly, no long-term wait and stuff like that. So your asset test ratio is going to be cash, accounts receivables, any receivables, but you stop at merchandise inventory. Why? I guess inventory just takes longer to sell, to get money for. You can go and you can send out Bubba and the good old boys out there to break a couple of thumbs and collect on accounts receivables. No, you won't do that in real life. You just call up your customer and say, I need the money right now, and start hammering them, okay? But inventory, you can't stuff that down customers' throats. They don't appreciate that. So here we go. Cash was 19,005. 37.4 for accounts receivable. Current notes receivable 9,100. There it is. That's your numerator. Just the first three. 66,000 divided by your current liabilities. There it is, 61,340. And it comes out to be 1.1. So almost a 1-to-1 ratio. It's a little bit better, but almost a 1-to-1 ratio. So if you really had to, if you're like going under, you're in a sinking ship, and you had to pay off your current liabilities, you could very quickly within, say, 3 months. Accounts receivable turnover ratio is net sales divided by average accounts receivable. And what they do over here, they got 770. Here's your sales, 770. That's your numerator. Your denominator, what they do is they have to, it's an average of accounts receivable. And what they're also throwing in here is current notes receivable. I guess they're throwing notes receivable in there as well. Okay, so just a heads up, this is what's coming. So they're going to include 37,004 plus 9,100. And since this is an average, I got to look at last year's balance sheet and figures. And I had accounts receivable to 29,800, which is right here. And I didn't have a notes receivable, so that's 0. So I add these guys up and I divide by 2 to get an average, because it took this year's number and last year's number, add them up, divide by 2. That's all it is. It's an average, because you don't see balance sheet figures throughout the year. They're a one-time snapshot. So I had a snapshot last year and a snapshot this year, and you take the 2, add them up, divide by 2, get an average. And so there's your denominator, your denominator, and so now it comes out to be 20.2 times. That means that your accounts receivable turnover is going to turn over 20 times a year. And if you really want to find out that answer, take that number and divide that into 365 days. You'll find out how many days it takes. That's a really quick way of doing it. They don't show that in the book. That's kind of like the industry way of doing it. Inventory turnover, same thing. This one takes cost of goods sold divided by average inventory. So cost of goods sold from your income statement right there, 585,100, divided by average inventory, and here's your merchandise inventory, 84,440, and then this 55,600 comes from right over here, last year's number for merchandise inventory, 55,600. Add them together, divide by 2. Come up with 8.4 times. That means you turn over your inventory about 8.5 times a year, roughly. The more you turn it over, the better. Okay. So days sales and inventory, we're looking at the turnover ratio, how many days it takes. And they're saying take the 84,440, which is your inventory, right there. Divide that by cost of goods sold. So literally, it's almost like this thing flipped the inverse, and then you multiply it by 365 days, and that gives you 52.7 days. 52.7 days. So the inventory sits for almost 53 days, at any one time. And then the last one in here is days sales uncollected. This is accounts receivable. How long does something sit in accounts receivable? And so you take 37,400 and 9,100. There's your numerator, divided by your net sales. So again, there's your inverse of what we just got through looking at for the accounts receivable turnover ratio. Multiply by 365 days, and the answer is 22 days. So things remain in accounts receivable for 22 days, and things remain in inventory for almost 53 days. So if you're, just out of curiosity, if you were to do your operating cycle would be 22 days plus 52.7 days. So operating cycle is this, and it's going to be 74.7 days. In other words, almost 75 days. How do I know this? Check this out, guys. Here's the operating cycles, what's called the cash-to-cash cycle, and I talk about this. You start off with cash. You use that cash to purchase inventory. Okay, then you sell that inventory to your credit sellers. Okay, so you sell your inventory and you create accounts receivable, and then you collect your accounts receivable to get cash back. Okay, so your cash is used to buy more inventory. You sell that inventory to your customers to create an accounts receivable. Then you collect the accounts receivable, turn it back into cash. You buy more inventory, and then you sell that to your customers to create accounts receivable, and you collect on accounts receivable. You understand why this is called the cash-to-cash cycle? Because it goes from cash, goes all the way through this, and becomes cash again. And so this right here was accounts receivable number of days, and number of days in inventory, total of about 75 days. That's this cycle right here. It takes 75 days to take cash and get it back to cash again. 75 days operating cycle. That's where this comes from. Okay. Awesome. Let's do part 2.